Today, we're digging into a visual language that came all the way from 18th century Japan, but that traders are still using right now to try and predict what the market's going to do next. They believe these simple little shapes can actually reveal the collective mind of investors, so let's see what they're looking for. I mean, seriously, what if you could actually see a market's hopes and fears, its confidence and its indecision, just laid out right there in front of you? What if you could get a real sense of its next move, just by understanding its mood? Well, for a long time, traders have been trying to do exactly that. They use a method that got its start in the Japanese rice markets way back in the 1700s, candlestick charting. The whole idea is that these shapes aren't just data points. They're a living record of the psychological battle between buyers, the bulls, and sellers, the bears. Okay, so to read this language, you've got to learn some of the vocabulary. Let's take a look at a few of the most famous patterns, kind of like the key words that traders are always on the lookout for. First up, we've got the morning star. So picture this. A market is falling, right? You see a big red or bearish candle, which means prices are dropping. Then a teeny tiny indecisive candle pops up. It's like the selling pressure is just running out of steam. And then, bam, a big green bullish candle shows up, signaling prices are on the rise. That whole sequence is seen as a classic sign that the bears are losing their grip and the bulls are about to take charge. And of course, there's a flip side. The evening star is basically the morning star's evil twin. This one shows up at the top of a big run-up in prices. You'll see a strong green candle, then that same small, hesitant candle, followed by a big, decisive red candle. It's the exact same story, just in reverse, a potential warning that the party might be over and sentiment is shifting from bullish back to bearish. And then you have something like the three white soldiers. Man, the visual of this one is just undeniable. It's not a subtle hint. It's like a slow, methodical march. You get three strong green candles all in a row, each one closing higher than the one before it. This thing just screams that there's been a powerful and sustained shift in control from the sellers to some very confident buyers. But here's the really important part. Experienced traders don't just see these patterns in a vacuum. Nope. They treat them more like clues in a bigger mystery, and they add all these layers of rules and context to try and filter out all the random noise. For example, take a classic pattern called the engulfing. Some traders have refined this into what they call a smart engulfing. They add a super strict rule. The main body of both candles has to make up at least 2/3 of the candle's total length. So why do they do that? Well, because short wicks, the little lines at the top and bottom, imply that the move was decisive. This rule is designed to filter for only the most powerful, high-conviction shifts in what the market is thinking. And this is where it really turns into a craft. A single pattern? That's not enough. A seasoned trader is looking for what they call confluence. Basically, a whole bunch of signals all pointing in the same direction. They're asking questions like, did this pattern show up at a really important price level? Does it actually agree with the bigger overall trend? Did the trading volume spike up to confirm it? The more times they can answer yes, the more they believe in the signal. So ultimately, this isn't about finding some magical shape on a chart. It's really about building a case. And by layering on all this context, traders believe they can turn simple pattern spotting from just a guessing game into a pretty sophisticated skill. It is a really compelling story, isn't it? The art, the craft, the psychology, it all sounds great. But you know us, we had to ask the tough question. I mean, if you strip away all of the context and all of that trader intuition, do these patterns, all by themselves, actually give you a real statistical edge? Well, a recent study in the International Journal of Innovative Science and Research Technology set out to find the answer. Researchers crunched 7 years of data for 5 of India's biggest and most traded stocks, and their conclusion, at least for the bullish engulfing pattern, was, well, it was pretty blunt. In isolation, it offered no reliable edge whatsoever. And just to show you what they mean, get this. For the tech giant Infosys, when a bullish engulfing pattern appeared on the chart, the stock price was higher the very next day, only 16% of the time. Yeah, you heard that right. 16%. That is significantly worse than just flipping a coin. Okay, but it wasn't all bad news. For a couple of other companies, the results looked way better. Reliance Industries had a 75% win rate, and Hindustan Unilever had a 71% win rate over 5 days. Now, both of those sound pretty impressive, right? I mean, they're crushing a 50-50 coin flip. But this is where the story takes a really interesting turn. So even with those high win rates, the study found that none of the results were statistically significant. Now, in statistics, a p-value is kind of like a test for randomness. You need a p-value of 0.05 or less to be confident that your result isn't just a fluke. The absolute best result in this entire study had a p-value of about 0.10. That's double the threshold. And what that means is that even that awesome-looking 75% win rate could have been nothing more than pure random luck. So, what are we supposed to do with all this? On the one hand, you've got generations of traders who absolutely swear by these patterns. And on the other, you've got cold, hard data suggesting they might not mean anything at all. So where's the truth in all this? Well, maybe the trader and the statistician are just asking two totally different questions. You see, the trader's art is all about combining these clues, the context, the volume, the location, to build a strong case. But the statistician's science is about isolating just one of those clues to see if it works on its own. The study tested a single word. The trader is trying to read the whole sentence. The academic data seems pretty clear. These candlestick patterns are not magic bullets. But hey, that doesn't mean they're useless. Their real power might be as a starting point. A faint signal that, when a skilled trader combines it with other analysis and context, can be sharpened into a genuine strategic edge. And that really leaves us with a fascinating final thought. As our markets get more and more dominated by algorithms and pure data, maybe the true lasting edge isn't found in a simple pattern at all, but in that uniquely human ability to weave together context and story and intuition. What do you think?